Chapter 13, Property, Plant, and Equipment, Depreciation and Depletion. The term property, plant, and equipment includes all tangible assets with a service life of more than 1 year that are used in the operation of the business and are not acquired for the purpose of resale. The three major subgroups of such assets are generally recognized as land, such as property used in the operation of the business, which has the significant characteristic of not being subject to depreciation; buildings, machinery, equipment, and land improvements such as fences and parking lots, which have limited service lives and are subject to depreciation; and natural resources, also called wasting assets, such as oil wells, coal mines, and tracts of timber that are subject to depletion as the natural resources are extracted or removed. The objectives for the audit of property, plant, and equipment include using the understanding of the client and its environment to consider inherent risk, including fraud risk related to property, plant, and equipment, and obtaining an understanding of internal control over property, plant, and equipment. The auditor will then assess the risk of material misstatement and design test of controls and substantive procedures as shown in this slide, and which will be discussed in greater detail in the presentation. In many companies, the investment in plant and equipment amounts to 50% or more of the total assets. However, the audit work required to verify these properties is usually a much smaller proportion of the total audit time spent on the engagement. In comparison with the audit of current assets, we find that there are significantly fewer transactions involved in the property accounts as compared to the current asset accounts. Second, there is usually little change in the non-current accounts from year to year. For example, the land account can remain unchanged for a long span of years. A third point of contrast between the audit is the significance of the year-end cutoff of transactions on net income. For current assets, the year-end cutoff is critical, but is of lesser importance to plant assets. The amounts invested in plant and equipment represent a large portion of the total assets of many industrial concerns. Maintenance, rearrangement, and depreciation for the assets are major expenses in the income statement. The total expenditures for the assets and related expenses make strong internal control essential to the preparation of reliable financial statements. Some of the applicable controls include an annual plant budget used to forecast and control acquisitions and retirements of plant and equipment, a subsidiary ledger consisting of a separate record for each unit of property, a system of authorizations requiring advance executive approval of all plant and equipment acquisitions, a reporting procedure assuring prompt disclosure and analysis of variances between authorized expenditures and total costs, an authoritative written statement of company policy distinguishing between capital expenditures and revenue expenditures, a policy requiring all purchases of plant and equipment to be handled through the purchasing department, periodic physical inventories designed to verify the existence, location, and condition of all property listed in the accounts, and last, a system of retirement procedures, including serially numbered retirement work orders stating the reason for retirement and bearing appropriate approvals. This slide shows the summary work paper for the analysis of property, plant, and equipment. Beginning balances for both the assets and accumulated depreciation are tied to prior year work papers, and additions and retirements are footed for agreement with the subsidiary ledger cards. The related work papers for additions and retirements and depreciation are cross-referenced. The auditors make conclusions based on the procedures, and appropriate initials and dates of performance and review are shown. The key audit working paper for property, plant, and equipment is a summary analysis that emphasizes changes during the year under audit. The working paper shows the beginning balances for the various types of plant assets. These amounts are the ending balance shown in the prior year's working papers. Next, the working paper shows the additions and retirements during the year. These are the transactions upon which the auditor's attention will be focused. A final column showing the ending balances that must equal the beginning balances plus the additions and minus the retirements. A similar set of 4 columns is used to summarize the changes in the accounts for accumulated depreciation. In the first audit of a company that has not been previously audited or one in which access to a predecessor's audit work is not available, the ideal approach is a complete historical analysis of the property accounts. By thorough review of all major charges and credits to the property accounts since their inception, the auditors can establish the validity of the beginning balances of property, plant, and equipment and accumulated depreciation. The auditor will use their understanding of the client and its environment to consider inherent risk, including fraud risk, related to property, plant, and equipment. After obtaining an understanding of internal control over property, plant, and equipment, the auditor will assess the risk of material misstatement and design further audit procedures. The auditor will determine the most appropriate procedure for the test of internal controls based on the nature of the controls that have been implemented. After testing of controls, the auditor will revise the risk of material misstatement based on the results. This slide lists some of the potential misstatements that can occur in property, plant, and equipment and examples of errors and fraud that can occur, and the internal control weaknesses or factors that increase the risk of misstatement. Fraud can include expenditures for repairs and maintenance expenses recorded as property, plant, and equipment acquisitions to overstate net income. The related internal control weakness associated with this fraud could be undue pressure to meet earnings targets. Errors can occur in recording purchases and retirements due to an inadequate accounting manual or incompetent accounting personnel. The substantive procedures of the audit of property, plant, and equipment include obtaining a summary analysis of changes in property owned and reconciling it to ledgers, vouching additions to property, plant, and equipment during the year, making a physical inspection of major acquisitions of plant and equipment, and analyzing the repairs and maintenance expense accounts. The auditor should also investigate the status of property, plant, and equipment not in current use and test the client's provision for depreciation. The auditor needs to investigate potential impairments to property, plant, and equipment and also retirements during the year. The auditor should examine evidence of legal ownership and review rental revenue and associated lease agreements from land, buildings, and equipment owned by the client but leased to others, perform any analytical procedures, and finally evaluate financial statement presentation and disclosure for plant assets and for related revenue and expenses. This slide lists the substantive procedures for property, plant, and equipment and the related audit objectives and management assertions. The vouching of additions to property, plant, and equipment accounts during the period under audit is one of the most important substantive tests. The extent of the vouching is dependent on the auditor's assessment of control risk for the existence and valuation of plant equipment. On a test basis, the auditor vouches purchases of property, plant, and equipment to invoices, deeds, contracts, or other supporting documents. They recompute extensions, footings, and treatment of discounts, investigating all instances in which the actual cost of acquisitions substantially exceeded the authorized amounts and determining whether such excess expenditures were analyzed and approved by appropriate officials. They should investigate fully any debits to property, plant, and equipment accounts not arising from acquisition of physical assets and determine that the total cost of any plant and equipment assets purchased on an installment plan are reflected in the asset accounts and that any unpaid installments are set up as liabilities. They should review changes during the year in construction in progress and examine supporting work orders, both incomplete and closed. They should trace transfers from the construction in progress account to the property accounts, observing propriety of classification and determining that all completed items have been transferred out of the account. The accounting for plant assets acquired in a non-monetary exchange are generally recorded at fair values unless fair value is not determinable, the exchange is to facilitate sales to customers, or the exchange lacks commercial substance. Assets constructed by a company for its own use should be recorded at the cost of direct materials, direct labor, and applicable overhead costs. However, auditors may apply the additional test of comparing the total cost of self-constructed equipment with bids or estimated purchase prices for similar equipment from outside suppliers. Excess cost of self-constructed assets should be expensed in the period that construction is completed. The auditor's principal objective in analyzing repair and maintenance expense accounts is to discover expenditures for fixed assets or other items that should have been capitalized. In performing this procedure, the auditor should be aware of the company's policy regarding the minimum expenditure to be capitalized. The auditors will analyze the repair and maintenance accounts with a view toward determining the consistency of application of this policy, as well as compliance with generally accepted accounting principles. The auditor will trace any large expenditures to written authorization for the transaction. One useful means of identifying capital expenditures that have been included in the repair and maintenance accounts is to obtain or prepare an analysis of the monthly amounts of expense with corresponding amounts listed for the preceding year. Any significant variations from month to month or between corresponding months of the 2 years should be fully investigated. Accounting standards require that long-lived assets be reviewed for impairment whenever events or changes in circumstances indicate that the carrying amount of an asset may be recoverable. In these circumstances, if the sum of the expected undiscounted future cash flows from the asset is less than its carrying amount, an impairment loss is recognized. The impairment loss is equal to the difference between the book value and the market value of the asset. Because the audit may include fair values that often involve substantial risk of material misstatement, the auditor may require the use of a valuation specialist. The audit of estimates of fair values often involves substantial risk of material misstatement. For a particular estimate, the level of risk is influenced by a number of factors such as the length of the cash flow forecast period, the number of significant and complex assumptions, the degree of subjectivity associated with those assumptions, and the availability of objective data. In auditing the values determined by valuation models, the auditor should evaluate the appropriateness of the model, the reasonableness of significant assumptions, and consistency of the model with economic conditions, existing market information, management's plans and strategies, past experience, and other financial assumptions and risk associated with cash flows. They should also test the accuracy, completeness, and relevance of the important data on which the fair value measurements are based. The principal purpose of the procedure of investigating retirements is to determine whether any property has been replaced, sold, dismantled, or abandoned without such actions being reflected in the accounting records. The steps an auditor can take to discover unrecorded retirements include investigating whether old equipment was traded in or replaced by new units. The auditor can also analyze a miscellaneous revenue account to locate any cash proceeds from the sale of plant assets. If any of the company's products have been discontinued during the year, they can investigate the disposition of plant facilities formerly used in manufacturing such products, making any inquiries of executives and supervisors about whether any plant assets have been retired during the year, and examining retirement work orders or other source documents for authorization by the appropriate official or committee. They last should investigate any reduction in insurance coverage to determine whether this was caused by retirement of plant assets. Accounting standards require lessees to classify leases as either operating or finance leases and record a right-of-use asset and lease liability for all leases with terms longer than 12 months. The auditor should carefully examine lease agreements to determine whether the accounting for the assets is proper. Auditors should be alert for the client's possible use of improper accounting techniques, including the following: assets under a lease are improperly recorded, such as failure to record assets and liabilities for all leases of more than 12 months. Leasehold improvements to buildings that are being depreciated over the useful life of the improvements rather than the shorter lease term when renewal is not reasonably assured, and improper accounting for items such as initial direct costs, lease incentives, and variable payments. The specific trends and ratios used in judging the overall reasonableness of recorded amounts for plant and equipment will vary with the nature of the client's operations. Among the ratios and trends used by auditors for this purpose are the calculation of total cost of plant assets divided by annual output in dollars, pounds, or other units, the total cost of plant assets divided by cost of goods sold, or the comparison of repairs and maintenance expense on a monthly basis and from year to year. Others include comparison of acquisition for the current year with prior years and comparison of retirements for the current year with prior years. The balance sheet or accompanying notes should disclose balances of major classes of depreciable assets. Accumulated depreciation may be shown by major class or in total, and the method or methods of computing depreciation should be stated. The total amount of depreciation should be disclosed in the income statement or supporting notes. In addition, adequate financial statement presentation and disclosure will ordinarily reflect the following principles. The basis of valuation should be explicitly stated. At present, cost is the generally accepted basis of valuation for plant and equipment. Property not in use should be valued at the lower of cost or estimated realizable value. Property pledged to secure loans should be clearly identified, and property not in current use should be segregated in the balance sheet. Determining the annual depreciation expense involves two decisions by the client company. First, an estimate of the useful economic lives of various groups of assets, and second, a choice among several depreciation methods, each of which would lead to different answers. Because depreciation is an accounting estimate, the auditors will use one or more of the following three basic approaches. Review and test management's process of developing the estimate. Review subsequent events or transactions bearing on the estimate, or independently develop an estimate of the amount to compare to management's estimate. For depreciation, while a combination of all of the approaches may be used, the emphasis is ordinarily on the first basic approach, reviewing and testing management's process for calculating depreciation. The first substantive procedure in reviewing depreciation is to review the depreciation policies set forth in company manuals or other management directives and determine whether the methods in use are designed to allocate cost of plant and equipment assets systematically over their service lives. Next, the auditor should obtain or prepare a summary analysis of accumulated depreciation for the major property classifications as shown by the general ledger control accounts, listing beginning balances, provision for depreciation during the year, retirements, and ending balances. The auditor should test the provisions for depreciation next. First, they should compare the rates used in the current year with those employed in prior years and investigate any variances. Next, they should test computations of depreciation provisions for a representative number of units and trace to individual records in the property ledger, being alert for excessive depreciation on fully depreciated assets. Generalized audit software can be used to test the depreciation calculations in the client's records if the client maintains computer-based records. The auditor should perform analytical procedures including computing the ratio of depreciation expense to total cost of plant and comparing with prior years, and comparing the percentage relationships between accumulated depreciation and related property accounts with those prevailing in prior years. In the audit of companies operating properties subject to depletion, such as mines, oil and gas deposits, timberlands, and other natural resources, the auditors follow a pattern similar to that used in evaluating the provision for depreciation expense and accumulated depreciation. They determine whether depletion rates have been recorded consistently and in accordance with generally accepted accounting principles, and they test the mathematical accuracy of the client's computations. In determining the physical quantities and rates of depletion, the auditors often rely on the opinions of specialists such as mining engineers and geologists. Under these circumstances, the auditors must comply with the provisions of AICPA AUC 630 and PCAOB 336 using the work of an auditor specialist. The auditors will investigate the ownership and cost of mining properties by examining deeds, leases, tax bills, vouchers, paid checks, and other records in the same manner that they verify the plant and equipment of a manufacturing or trading concern. All intangible assets are characterized by a lack of physical substance, and their value lies in the rights or economic advantages afforded in their ownership. Assets with definite useful lives are audited similarly to property, plant, and equipment. Intangible assets with both definite and indefinite lives should be reviewed for impairment when circumstances indicate that the carrying value of the asset may not be recoverable. If specific intangible assets appear to be impaired, the auditor should evaluate the reasonableness of management's estimate of the fair value of those assets. Auditors generally rely on business valuation specialists to value goodwill for test of impairment. Most of the audit work on plant, equipment, and intangibles can be done in advance of the balance sheet date. For the initial audit of a new client, the time-consuming task of reviewing the records of prior years and establishing the beginning balances in the accounts for the current period ordinarily will be completed before the year end. In repeat engagements as well as in first audits, the consideration of internal control can be carried out at a convenient time during the year. Many auditing firms lighten their year-end workloads by performing interim work during October and November, including the analysis of the plant and equipment ledger accounts for the first 9 or 10 months of the year. After the balance sheet date, the work necessary on property accounts is then limited to examination of the transactions for the final 2 or 3 months. And this is the end of the presentation for Chapter 13.